Hello, everyone. Good evening. I hope you are all fine. We are back here again. All right. So today we'll be talking about the tutorial set one of the taxation. All right. So, and basically, this tutorial set is basically more of like understanding the basic principles of tax, like more like the definition, like the introduction of tax, right? So it's more going to be explanatory stuff. So I wouldn't really talk much about this. I'll be only talking about the key points and then how you are going to be answering this kind of questions, right? Okay. So basically, whatever I'll be saying will be based on how our TA was telling us to be answering these kind of questions. All right, so question 1A, a tax may be described in a number of ways based on the relationship between income earned by a person and the tax rate applicable to that income. Again, an important feature of a tax system is the percentage of the tax burden relative to income or consumption. Thus, the terms progressive, proportionate, and regressive are used to describe the way the tax of the the way the rate of tax progress from low to high, from high to low or proportion. So in the requirements here, in relation to the scenario above, explain progressive, proportional, and regressive taxes, stating the main features that distinguishes them. So what this is trying to ask us to do is to explain the progressive tax system. So the progressive tax system is a type of tax system where the proportionate or the percentage paid as tax increases when the income level also increases, right? So an example here was the pay as you earn, right? So here, the percentage or the proportionate of tax increases, not the amount of tax, but the percentage or the proportionate of tax increases, whilst the income level also increases. All right, so with proportional um income, proportional tax, sorry, the percentage or the proportional or the proportionate, or let's say the percentage, sorry, is stable, right? It becomes the same irrespective of the income level, whether the income level increases or decreases. A flat rate is being paid. So an example can be a corporate tax. So a tax that is being paid by companies, it is 25% irrespective of the type of company, right? So it's what proportional to the income level of the uh, consumer, right? Of the person paying the tax. So the distinguishing feature here is that for progressive, the tax rate increases when the income level increases, but for proportionate, the tax rate does what remains the same, even if when the income level increases or decreases. Then regressive taxes. For regressive taxes, right, as the income level increases, right, we rather pay less proportion and less percentage of our income as tax. So an example here can be VAT, valued added tax. So the percentage, the amount paid on each and every good um, based on the income level is different. So you can be earning 10,000 and then your VAT will be, let's say, 2 cedis, and you'll be earning 1,000 and so you'll be paying the same kind of VAT. So with this, you are going to you having the 10,000 is going to have a smaller portion of your income being paid as tax, whilst you having the 1,000 will be facing like a higher percentage of your income being used as tax. So the distinguishing feature here is that for progressive, when income level increases, the tax rate also increases. For proportional, when the income level increases or decreases, the tax rate becomes the same or is the same. And for regressive, as the income level increases, the tax rate is what? Decreasing or it reduces. All right. So Question B here. The Ghana Revenue Authority is made up of two operational divisions, the Domestic Tax Service Union, the Domestic uh, Tax Revenue Division, and the Custom Division, with assistance from the Support Service. Yeah, with the assistance. So in reference to the above statement, State 5 direct taxes administered by the Domestic Tax Revenue of Ghana, right? So some examples of the taxes that has been administered by the tax revenue of Ghana is one, the corporate income tax, then two, personal income tax, then three, pay as you earn, four, tax stamp, five, mineral royalties, six, capital gain tax, seven, gift tax, eight, we have rent tax, right? So basically, that is it. Okay, I've also written the answers now. Let me rather show a full screen so that you also get answers on the answer. So the first thing we are just told to just state. So we are not explaining, we are just stating them. That's why I'm just mentioning them. All right. So we are done with question one. So question two. So this is basically question one. Basically the answers for question 1B. So now let's move to question two. Question two, Adam Smith, reputed as the father of economics, postulated the characteristics of a good tax system as equity, certainty, convenience, and economy. These postulates, these postulates are still as relevant today as they were in Adam Smith's days. So our requirement is that we should explain how these characteristics of a good tax system can be employed by the Minister of Finance of Ghana to improve the system of Ghana. So in case we are asked this kind of question, you explain the characteristics and then you make sure that you link it to how it is going to improve our tax system in Ghana. So for example, this is my first answer to this. So basically, Adam Smith four characteristics of a good tax system: equity, certainty, convenience, and economy are fundamental principles that can guide the finance ministry of Ghana, improving the nation's tax system. So the first one, so the tax system should be fair. So when we talk about equity, it means the tax system should be fair. We spoke about this in our first session, right? Meaning individuals should contribute taxes based on their ability to pay. Higher income individuals should bear a proportionately larger share of the tax burden, whilst lower income individuals should not be overburdened. So the finance minister can ensure equity by implementing a more progressive tax structure where wealthier citizens and profitable businesses pay higher taxes while providing tax relief or exemption for low income earners and small businesses. This could include revising tax brackets, introducing wealth taxes, and reducing indirect taxes like VAT that disproportionately affects the poor, right? So my notes, these are self-explanatory, and then I don't know if I should add more flesh, but I think this is okay. So for the certainty, we should what? Know the amount of tax we are going to pay. That is the principle of certainty, right? So that's basically it. So so how the finance minister can be helped with this is that the finance minister can improve certainty by simplifying and clearly communicating tax regulations avoiding abrupt changes in tax policies, and ensuring that tax laws are stable and predictable, right? So if they are stable and predictable, then we will always know the amount of tax we are going to pay, right? Therefore, enhancing the tax collection process and the tax paying process. That is basically it. So the convenience. Convenience talks about the process of paying taxes should not be overburdensome. So like it should be easy. Ah, you be calling people all right, so all right, so convenience. So the process of paying tax should be convenient and not be over. So it should be easy to pay the tax. It shouldn't be very difficult for you to be paying taxes. Otherwise, we will be discouraged, right? So the finance minister can improve the convenience by digitizing, by digitizing the tax collection system, making it easier for individuals and businesses to file taxes online and make electronic payments, reducing the complexity of filing procedures and offering tax payer assistance service can also encourage compliance. So this is next year. Then the economy. We know that the economy talks about the cost that's involved in taking the tax. So if the cost is more than the tax being taken, then it is not economical. But so the economy principle states that the cost of getting a particular tax should be less than the actual benefit you are going to get from the tax. So the way the finance minister can improve is by investing in more efficient tax administration system that reduce the cost of collection and enforcement. So by using technology to track and collect taxes, the government can reduce human error and fraud while improving revenue collection, streamlining tax audits and focusing on sectors with high evasion risks can reduce administrative costs. So you can also bring this conclusion and stuff. All right. So now question of B of the part two. So countries worldwide experience fluctuations in economic activities, which affect the consistency in government revenue generations. For example, when income levels are high, all things being equal, tax revenue rises. Conversely, when income level falls, tax level drops, requiring government policies to address the fluctuations. Government therefore employs expansionary and contractionary fiscal policies to moderate the effect of such fluctuations, right? So, uh, explain the following forms of fiscal policies: automatic stabilizers and then discretional policies. So, for automatic stabilizers, it is more or less like an automatic way where the it's more or less like an automatic way of making the economy run in an optimal form, right? So when there is more spending, the system is automatically adjusted to tax more so that the spending will reduce. And when there is less spending, automatic adjustment will come in to tax less so that more spending will come in. But for discretionary fiscal policy, there's more or less like a decision is supposed to be made to implement those either high taxes or low tax. But for the automatic stabilizers, no decision will be made, but measures has already been put in place that will regulate that. So let's look at it here. So automatic stabilizers are two forms. So automatic stabilizers are built-in fiscal mechanisms that automatically adjust government spending and taxes without the need for new legislation. right? You don't need to implement new legislation. It will automatically adjusted. They help smooth out economic fluctuations by naturally increasing or decreasing government intervention as economic conditions change. During an economic downturn, automatic stabilizers increase government spending through higher unemployment benefits or reduce taxes as income level what fall, helping to maintain demand. So conversely, in a booming economy, tax revenues increases, people earn more and spending on welfare decreases, reducing the demand and preventing overheating. So that's basically the example include unemployment benefits and progressive tax system, right? So basically that's it. I explained it before reading. So the discretionary the discretionary fiscal policy also involve the deliberate action to change spending or taxation. So here it is more or less like a policy will be put in place, right? So unlike the automatic one, the discretionary measure require legislative approval, right? You will put the measures in process and then Parliament is supposed to approve it and are used for targeted economic intervention. In times of recession, governments may use expansionary fiscal policies such as increasing public spending or cutting taxes to stimulate demand and create jobs. In high inflation or economic overheating, contractionary policies like raising taxes or cutting government spending can reduce demand and control inflation. These policies are flexible but may face delays due to political legislative process, right? So that's it. So question 3, when introducing new taxes in a developing economy like Ghana, the contribution of the new tax system to the buoyancy of the country is important. However, this will depend on whether the new tax instrument will be progressive tax or regressive tax. So here, explain the difference between progressive tax system and regressive tax system and state one example each of the tax instruments, right? So we've spoken about progressive, where we say when the income level increases, the proportion you pay as tax also increases. And we made mention that an example is what? The pay as you earn. Whilst the regressive tax system, whilst the income level increases, the proportion you pay as tax what decreases. And an example is what? The valued added tax or the VAT. So that's basically the same thing here. That's basically the same thing here, right? All right, so the B. B is saying that distinguish between the features of direct and indirect taxes. So we know direct taxes are paid straight by an individual or a company, whilst indirect taxes are not are paid through the consumption of goods and services, right? So direct taxes are attributed to either income or company profits, whilst indirect taxes are attributed to the consumption of goods and services, right? So some of the features or some of the differences between them is that um, here for the direct taxes, they are charged on income and profits, whilst here goods and services, one of them. And the other one is that, see, so okay, the taxpayer, individuals and businesses, here end consumers of products, goods and services. Then we also have meaning paid directly to the government, whilst paid to the government via an intermediary. Then the tax rate directly depends on the income and profit, while this one is same for everyone. So burden, the tax burden, this is progressive, meaning as you earn more, you pay more. And here, this is regressive. The rate of tax is flat, so tax burden is regressive. And then the transfer of liability for the direct tax is not transferable, while the indirect tax can be transferred from the producer to the consumer. Tax collection here is complex, whilst here is quite convenient. Then types, income tax, and then security tax. Then we also have goods and services tax. So the evasion here, you can possibly evade it. Here you cannot, because you consume the good and service, and then the price will be added to it. The tax rate will be added to it, or the tax paying here economy. This is less economical because a thing. Once the indirect is more economical because once the good is in per, then certainty, more certain to get it, and yet less certain to get it. All right, so now let's look at the C. The C in India, it is more of true and poor. A tax a taxpayer is not satisfied with the Commissioner General's decision required. Explain the procedure to be followed in objecting to the Commissioner General tax decision. Right. So it is more made this thing there true and poor. So this is it here. A person who is dissatisfied, first one, a person who is dissatisfied with a tax decision that directly affects that person may lodge an objection to the decision with the Commissioner General within 30 days of being notified of the tax decision. So an objection to a tax decision shall be in writing and state precisely the grounds upon which the objection is made. To a person, the third option is a person may, before the expiration of the period, apply in writing to the Commissioner General for an extension of time to file an objection, the bracket, on the grounds of absence from Ghana by the objector, sickness, or other reasonable cause. So when satisfied, the fourth one, when satisfied, there are reasonable grounds for the extension. The Commissioner General may grant the application for the extension and shall serve notice of the decision. An objection against a tax decision shall not be entertained unless the person has one, in case of import duties and taxes, paid all outstanding taxes, including the full amount of the tax in dispute. And two, in the case of other taxes, paid all outstanding taxes, including 30% of the tax in dispute. So now, the Commissioner General may, however, waive or vary or suspend the payment above pending the determination of the objection, or take any action that the Commissioner General considers appropriate, including the deposit of security. Here, the Commissioner General shall consider the need to maintain integrity of the dispute, resolution procedure, and the need to protect government revenue and integrity of the tax system as a whole in exercising a discretion. So a tax decision, that is the tax decision objected to, as many have been amended by an objection decision. The objection decision, section 443 of the Act 915, after consideration of an objection, the Commissioner General may vary the tax decision in whole or in part or disallow the objection. The Commissioner General shall, within 60 days of receipt of an objection, serve the objector with notice of the decision, including the reason for the decision. Where the Commissioner General does not serve the person with notice of the decision within 60 days, the person may, by notice in writing to the Commissioner General, elect to treat the Commissioner General as having made a decision to disallow the objection. To all this, I'll make sure I issue them before exams. All right. So question 4 talks about deepening and widening the tax system. So yes, it's here. So question 4. In order to generate more revenue for national development in Ghana, tax experts often suggest that they need to deepen as well as widen the tax system of Ghana. Explain the difference between deepening the tax system and widening the tax system, and suggest how Ghana Revenue Authority can deepen and widen the tax system of Ghana. So basically, widening the tax system basically means that adding like other new tax to the system. So for example, initially we were not having betting tax, but betting tax has been introduced. So it's a form of widening the tax system, right? And deepening the tax system basically means that increasing the rates. So if already we are paying 25% as corporate tax, it can be increased to 30%. It's for deepening the tax system. That's basically it there. So you can see. So widening the tax system entails including instruments in the tax system that were previously not in the system. So that's what NPP government was doing. So this would include introducing new taxes. Example, e-levy, COVID-19 levy, and the likes, right? Subjecting people to tax who were previously exempted from, who were previously exempt. For example, by lowering the tax threshold, etc. Widening the tax base and system is therefore meant to increase government revenue. Tax deepening is when the government imposes taxes on the same people in respect to the same activity, right? For example, increasing the tax rate or the salary and deduction. So tax deepening have value beyond raising revenue. They would help the tax law adhere more closely to the principle of horizontal equity. We spoke about horizontal equity. The core public finance and taxation theory concept stating that two people with the same income should not pay significantly different effective tax rate based on the ability to exploit tax laws, preferences, or loopholes. So with high levels of tax overload worldwide, widening the tax base is no longer a viable option for most countries that have already out-widened their tax bases. The remaining option would be to deepen the tax base, which is by no means a viable option, right? So that's basically it. So since most of the countries have already added new taxes, including more taxes is more not viable. But now, if they will increase the tax rate, then it will become sort a bit viable, right? So now, let's look at question 4B. Taxation is a mechanism through which the government seeks to realize some of its economic objectives. It is one of the oldest means by which government expenditure is funded. Taxation plays a central and significant role in developing countries all over the world. Explain 5 economic rules of taxation. This we know: to raise revenue, to um, to raise revenue, to also finance budgets, to control inflation, to okay, so raising revenue for public expenditure. Yes, so this is some brief explanations here. Then we also know to redistribute or redistribution of income. Basically, in this type of economic rule, the richer is being taxed more, right? Whilst the poorer is being taxed less. And yes, the richer is supposed to be taxed more because when the government uses our taxes to pay the rules and stuffs, for example, me, the poor one, I'll be working. But the rich person will be using car on the road. So the richer will be benefiting more than me. So he's supposed to be taxed more. So that's it for the redistribution of income. Then controlling of inflation. So when the prices of goods and services are so high, right? Then the government tends to what? Taxes are increased to reduce the disposable income. So, we know that when inflation increases, it's because we are having more money in our hands. That's why. So when the government taxes us and then we have less money in our hands, we tend not to buy more. So therefore, what's causing inflation to what? Decrease. Then we also have redistribution of the local industries. So some industries, for example, depending on their locations, receive some kind of tax rebates. So manufacturing companies sited in the capital region, other than Accra and Tema, enjoys a 25% tax rebate, whilst those located in non-regional capital enjoys 50% tax rebate. So in the case of young entrepreneurs, tax rate applicable for the 5 years period after the initial concession is what? Zero. And Accra and Tema so would enjoy incentives as the Accra Tema tax rate is 25%. Other regional capital outside the three northern regions tax rate is what? 12.5%. And outside the regional capitals tax rate is what? 10%. So what? It's help in what? Building or bringing up more industries. Then encouragement of investment in certain sectors of the economy. So farmers, for example, enjoy tax holidays of 5 to 10 years, depending on the nature of farming activity, right? So because of that, people will be investing in farming. Then real estate developers also enjoys a tax holiday, enjoy a holiday of 5 years, right, for 5 years. And also venture capital firms also enjoy tax holidays of 5 years from corporate income tax and dividend and then capital gains. Then privately owned investors also shall be exempt from tax when they plow back 100% of their profits after tax into the business. So it also helps to control what? Budget deficit. So budget deficit is basically when our expenses are more than our targeted revenue. Then we use tax to what? Curb that kind of deficit. We tax more, we get money to what? Control that budget deficit. Then promotion of export taxation. So basically what it means here is that because the government will want our goods to be competitive on the market, tend to what? Apply or put less tax on our exports so that we can be able to what? Export more. So this may be used to promote exports. Under the income tax, companies engaged in the production and export of non-traditional goods enjoy a concessionary tax rate of 8%. Also, under the VAT Act, whatsoever, exports are zero rated to make export products competitive in the international market. Non-traditional goods are defined under the first schedule include horticultural products, processed and raw agricultural products grown in Ghana, other than cocoa beans, wood products, other than lumber and logs, handicrafts, local manufactured goods, and etc. Then it also helps in what? Discouragement of consumption of certain goods, right? So for example, alcoholic beverages and stuffs in my lectures, I even use origin as an example with this one. And then protect infant industries. Government tend to tax infant industries, tax other industries or other like imported goods, so that small industry that tends to what? Produce similar goods can what? Um, uh, can be able to stand or withstand whatever is the barrier for them. So basically what this means is that, so if let's say a firm here is producing shirts and then we tend to import similar shirts, right? Government will tend to then tax the one that has been imported more, to make the local one cheaper so that the local one can what? Excel. So indigenous industries at their teething stage with higher cost of production face stiff competition from foreign goods imported into the country. Import duties and tariffs are raised to protect these industries. So that's basically what the NPP government was doing, making the port duties so high so that the locally producing car, like for example, tanker can be patronized, but still never. Stimulation of economic growth. In times of depression in an economy, taxation can be used as an instrument to okay. Taxation can be used as an instrument to stimulate growth. This can be done right. So this can be done by reducing taxes to enable companies plug back or reinvest profit that would otherwise go into tax payment, right? Then also attract foreign investors. So taxation can be used as an instrument to attract foreign or direct investors. So taxation and tax incentive like tax holidays, among others, can attract foreign investors to invest in our economy. So this gives investors opportunity to fully recoup their investment during such periods, as well as reinvest such in order to operate on a large scale. This brings about economies of scale. Again, capital allowances provide businesses the opportunity to recover the amount they spend in capital expenditure. All this will eventually result in an expanded economy in the long run, right? So now let's move on to question 5. So explain the taxation principle of the following: residents and non-residents. Right. So basically, a resident will be taxed irrespective of whatsoever. So resident individual is a tax on global income or worldwide income. It doesn't matter whether the income is brought into the country or not. This is based on integrity and exchange of information instrument. Non-resident is taxed on income accrued in Ghana and derived from Ghana. This is that is that is income that has a source in Ghana. Income brought into or received in Ghana is not taxed. We've spoken about this in session 1 already. So B, the development agenda of a developing country like Ghana can only be brought to reality through the availability of funds. The two main sources of government revenue are taxation and debt. In spite of the fact that taxation remains the most reliable source of government revenue for government plans, projects, and programs, it's said to be limited in its role and function in the economy. Justify the use of public debt as an alternative to taxation, right? So why would you use public debt uh instead of taxing the citizens, right? So public debt enable government to facilitate growth, take off by investing in a critical mass of infrastructure projects, right? So sometimes if the government also needs quick money, right, taxing will take a lot of time. So you need to what? Get the debt fast. So where taxation capacity may be limited, right? And then the other one is tax becomes a disincentive after a certain point, right? So when you tax and tax and tax and tax, it becomes a disincentive at certain point, and therefore public debt will be needed. Public debt supports tax smoothing. Public debt facilitates tax smoothing and counter cyclical fiscal policies essential for reducing output volatility. Then it's public debt also helps align cost with benefit. It permits an equitable alignment of benefits and cost for long gestation paths if gestation projects by shifting taxation away from the current generation. So when debt is applied well, it improves the standard of living because taxes will increase the standard of living, right? But debt will not increase the standard of living when it is being applied well. Then public debt attracts foreign investors, right? So if the government issue bonds and stuffs, foreign investors will what? Then invest in the country. All right. So in emergency situation, public debt is needed. So when you need to complete a particular project fast, you will need public debt because tax will take time before it will come. So for example, when Ghana first reported two COVID-19 cases, we immediately applied for a loan to combat for the COVID-19 pandemic from the World Bank, right? We didn't wait to take taxes. We applied for a loan, quick one. So now let's talk about question 6. So question 6A, the tax system can be classified in many ways. It could be based on the method used in the computation of the tax or based on the incidence or responsibility for the payment of the tax. To explain the structure or classification of Ghanaian tax system. So we've spoken about this. So based on methods, right? It it can either be proportional tax system where it said the irrespective of the income level, the percentage paid as tax remains the same. Then progressive, when income level increases, when income level falls, the tax rate rather what increases. And then regressive, oh, sorry, progressive, when income level increases, tax level or tax rate also what increases. And regressive, when income level for tax rate what increases. That's basically it. So based on who has the responsibility can be whether the direct or indirect tax. And we know about this, that the direct tax is being paid by the individual or corporate firms, right? So a direct tax is a kind of charge which is imposed directly on the taxpayer and paid directly to the government. While the indirect tax here is the impact or incidence falls on different people, right? So here the incidence is being paid directly, the incidence falls directly on the payer, whilst here it's being falls on different people. Indirect taxes are taxes on spending. It is a tax collected by an intermediary, such as a retail store from the person who bears the ultimate economic burden, such as the customer. So basically, these are some of them. So B. B talks about the government budget plan is a plan of government revenue and expenditure for a specific period, usually a year, where when budgeted expenditure exceed projected tax revenue, the budget is projected to be in deficit, right? This will lead in deficit financing. So they've even explained what this is. So they are telling you to describe briefly the um causes of so for the goals of public expenditure, we've spoken about it up there, right? And also for causes of budget deficits, we've also spoken about it briefly, but let's talk about it. So here, during a period of depression, so deficit financing assume greater importance when there is the need to recover So this happens when there is realization that private sector's activities as well as traditional monetary policies prove to be inadequate, right? So we cannot raise enough money. And then during wars, government tried to raise additional resources to finance tribal conflicts during tribal wars. This may, however, have negative effects on inflation. And then during the process of economic development, usually in developing countries, deficit financing is applied to cater for the meagre voluntary investments in order to progress rapid development, do away with various vicious cycle of poverty. Then ineffective financial management is also the weak expenditure control and monitoring, and then low revenue mobilization. Then the final is political pressure. When there's political pressure, it also tends to what cause deficit financing, right? So this brings us to the end of this session. Kindly like and subscribe, like this video and then subscribe to the channel for more. Thank you very much. See you in the next video. Bye.